Welcome to the Money Mindset Mastery Show. With us today, we have the usual Jim and Ryan, and we have a guest actually coming back for a second time. He liked it so much. We have Kyle from Newlook Capital. Last time we talked about the dental fund. This time we're going to talk about their industrial and infrastructure services fund. As interesting and unique as the dental fund is, but before we get into it, we're here to help people make money decisions. That's really our end goal. We want to be able to help people to understand what to do with their money. Today, this is a focus on a lesser known way to invest in essential services, things like fire protection, water services, plumbing, cell phone towers, a lot of really interesting things today. So I'm going to start by introducing Kyle. Kyle is in charge of letting us know today about Newlook and the Infrastructure Services Fund. They focus on recurring essential service businesses, which really are good at providing a stable part of your portfolio. But we do want to say private investments come with a lot of risks. We'll kind of get into some of the risks as we go. This is not advice. This is the discussion. Really, we just want people to be able to learn and get some education from what we talk about today. If you don't have an advisor, you can give me a call, but make sure you get that professional advice because there's a lot of nuance that we just can't cover in an hour episode. So let's start into it, Kyle. If I'm a regular investor listening to this discussion, in one sentence, why should I care about Newlook as a company?
Yeah, absolutely. And, really appreciate you guys having me on again. Obviously, last time we spoke about the dental fund, and this time we're going to talk a little about the industrial and infrastructure services portfolio. But for us, I think we do private equity a little bit differently. We consider ourselves to be business builders. We really don't use leverage. We focus on fundamentals. So I think that's a main reason why investors should take a look at New Look. We do things a little bit differently. Obviously, you've seen a lot of institutions gravitate towards, private equity and private alternatives. And that's no mistake, right? There's a reason behind that. So, and I think we're kind of at the forefront of that.
Let's touch a little bit about on your history before we get into more New Look. What drew you to New Look? What was your history before you got there, and why have you chosen this as a place to hang your hat?
Yeah, no, it's a great question. I've always had a very entrepreneurial mindset. I was a multi-sport athlete at the University of Guelph, did my educational background is in finance and economics. So obviously through that, learned a lot about investments, not a whole lot about the private side, to be honest. But what kind of drew me once I got into the industry, I learned a little bit more about private equity and private investments, private alternatives. And what drew me kind of specifically to New Look, obviously my desire to be an entrepreneur. This is kind of as close as you can get, right? I'm working with entrepreneurs on a regular basis, those who are looking at selling their businesses, growing their businesses. And my family kind of has a history of entrepreneurship. My grandfather started a paint and wallpapering store in my hometown, and my dad took it over. So kind of a history there. And I thought, you know what? What's kind of similar to that is the businesses that we're kind of buying. So I just thought there was a lot of crossover from my early life into kind of what New Look is looking for.
It's interesting to hear entrepreneur stories because it doesn't matter what business you're in, the acceptance of that risk that's involved, the being innovative, the working hard, there's a certain group of attributes that really do kind of run through all of the people I've met that have that tendency, and it's really why I like New Look so much. So, as an investor, let's get into New Look specifically. Who am I backing? That's what I always like to know. Like, who are the people that are making this happen, and what should the listeners know about their background and their experience?
Yeah, so we kind of started as a bit of a family office for our CEO, Elroy. So Elroy being kind of a serial entrepreneur himself, he's done a great job across all sectors, all markets, whether that be real estate, logistics, retirement homes. He's kind of done it all, and he's seen and curated the ability to create growth in a whole bunch of different business sectors, which I think is great, having that expertise and then kind of creating this repeatable process. So what I kind of like to talk about with, the founders of New Look, our current six partners are the original founders at New Look Capital. So you get great consistency at the fund level. The people that you're backing have been here since the very beginning. They've put all of their own money behind New Look Capital since inception. Again, we've got Elroy as our CEO. We have Abbas as our CIO. He's worked a ton in the investment industry, is on multiple advisory boards spanning across the globe, and he's overseen quite a few family offices and how they allocate their money. So we've really been able to tailor our offerings to what he's seen over the last 20 plus years in the market. And then we've got Tony, our CFO, Gavin is our head of sales, Haas is our legal counsel, and then Oliver heads up our industrial fund. So as I said, these are the original 6 people who've put their own money to back Newlook and all have great business backgrounds, whether it be in M&A or kind of their own dealings.
Yeah, that's a really important distinction I always make with my clients. And that's one of the reasons why I like how Raintree does business. They really do focus on what we call, for those who are listening, alignment. We want to know that the managers who are managing the investment are heavily, or if not perfectly, I'm not sure you can ever be perfectly aligned, but the more aligned managers and investors are, when the managers make a decision that says, hey, this is going to be positive for us as managers, then it also benefits the investors. And maybe talk really quickly about how New Look builds alignment into the structure so that the decisions they make also piggyback the investors along in that.
Yeah, that's a great question. So for us, the management team has always kind of put their own capital into the existing funds at Newlook to start off. And then from kind of a profit sharing structure, New Look benefits from growth of all of our portfolio companies and the growth of the platforms. So it's to our advantage to actually grow these fundamentally, grow these businesses, sell them kind of as we have kind of set out to do, because that means that we share in that profit with our investors, right? If we're not making any growth or these investments aren't growing, we're not selling them for a profit, it means New Look's really not getting anything out of it. So we make sure that we have that on the industrial side. It's 5% of the fund value is actually the alignment with New Look. So again, as you know, we kind of go into more of what the fund is comprised of and kind of the size of the fund. You'll see that's a meaningful chunk of capital that we want to see grow with our investors.
Yeah, that makes sense. Appreciate that detail. So let's kind of move a little bit more in depth into New Look itself. The dental fund was easy. Dentists, everyone's been to the dentist, I hope. And if you've been to the dentist, you kind of have an idea of that. When you get into the industrial and infrastructure services, industrial and infrastructure covers, probably half of the businesses in Canada to some degree. What what falls into the category specifically that you have now, and what's not in there that you might be looking at adding in the future?
Yeah. So uh, there's a very specific specialization to what we do, right? Like we want to be a specialized firm. And I think that's how we can extract a lot of that value for our investors. But for us, when we want to grow all of our portfolios to be recession resilient. So kind of the way that I frame it is essential service type businesses. And, these are the businesses that are the backbone to the economy, right? For an example is, fire suppression. You see a ton of infrastructure, obviously across Canada, across the US. We are kind of the boots on the ground, the men and the women that are servicing all of this infrastructure. So I know you said dental, very easy to understand. Everybody gets that. But I do think infrastructure and industrial services businesses, everyone does understand that as well, right? A lot of these services can be residential. We tend to go more the commercial route. But if you just think about, the sprinkler systems, the alarm systems, whether that's in your house, in your office building, those are the types of businesses that we look at buying. So we're doing the installation, the maintenance of these systems. Commercial plumbing is another big one for us. All the water that you see kind of run through your taps, we have a platform down in the US that actually does all the fresh and the wastewater treatment. So again, these are very tangible things that you can see every single day. We are the group that provide capital and help grow these businesses of great operators that service these businesses or this infrastructure. So I think it is relatively simple, maybe not quite as simple as dental, but I think you'd be surprised at how much of these types of businesses people touch every day.
Carl, are you looking at a specific business size? Or are you staying away from a certain size to invest in?
Yeah, that's a really good question, Jim. So I think so our whole business model kind of stems from the fact that we play in a space with businesses that are smaller than these larger BlackRocks of the world or the KKRs are going to go after. We don't want those big businesses. We're looking at, call it million to $2.5 million in EBITDA companies. And we want to grow them to a point where they can then be sold to these larger private equities or strategic partners. And that's how we create a lot of our value. Because the multiples that we're buying on entrance, we really haven't seen any movement on that. It's 4 to 6 times kind of since the inception of the fund. But we really create that value when you hit certain thresholds and we grow these businesses. And that's where we extract a ton of that value. So I talked a little bit about the businesses that we're currently in. We love the wastewater space. We love the fire suppression space. We might be getting a little bit more into air quality control testing, elevator maintenance, gas detection. These are the kinds of businesses that we really love.
You make a really good point. I think these are very well known, but also very unknown in the sense that, like, I mean, you walk into any commercial building, you go into a McDonald's, you go into a hair salon, they have fire suppression systems that have to be inspected regularly. You go to a concert, they have gas detection systems that need to be checked on regularly. The wastewater, every house, every business, every industry has a connection to that. So while it's every day, I think a lot of people don't necessarily think that deep about walking into a store and all of those things. You touched on, you said a word, code regulated or code mandated. Touch on that detail a little bit because I think that that really has a pretty significant factor in the stability of how you guys aim to create revenue.
When we're looking at businesses, they have a component of service revenue and they've got a component of project-based revenue. So some of these businesses are actually installing and doing the project-based work in some of these commercial buildings. And then a portion of that is we then service what we've installed effectively. So for us, it has to be code mandated. And what I mean by that is there's some regulatory body that oversees what we're doing. And they have mandated that this needs to be done on, call it a biweekly, a monthly, or a quarterly basis. And what that allows us to do is buy these businesses because we're going to be spitting out cash flow to our investors, as you guys are well aware. So we want to make sure if there's an economic downturn or whatever kind of macro forces are at play, this service has to get done. It really does not matter what's happening on the outside. So that's where that code mandated kind of regulatory piece comes in. It really helps us predict our cash flow that's coming in and then obviously knowing we're able to distribute that to our investors.
Yeah, I think that that's really the key. I remember you guys talking about during COVID when everything was upset. You might be able to call that a black swan event. Maybe it's not quite that, but the point is, whenever those really big, groundbreaking moments come that test businesses, it's always interesting to see the ones that just continue. Maybe tell us how it affected the companies you guys had in your funds at the time.
Everybody obviously suffered through COVID. It didn't really matter what business you were in. But again, having that service component, typically we want it to be like 40 to 45% of the revenue comes from that service side. All these buildings still had to be serviced, right? What it did was delay a bit of the project based work. You couldn't really get into the buildings and do that kind of stuff. But the safety of these buildings still had to be made very clear and inspected, et cetera. So that side is really what drove kind of that cash flow through COVID. The project based stuff, we didn't lose any of it. It just got deferred until buildings opened again. And then we had this backlog and then we were able to kind of catch up on our revenue. So there was no real loss throughout COVID, which is why we love this, but more or less kind of deferred.
So, from an investor's perspective, when you're telling people about this, what's that aha moment when people really first understand the core of what you guys do with this fund?
Yeah, I think what I really try and tell people is we're business builders. We're not in the private equity space. I mean, we technically are if you want to label us across kind of traditional asset classes, but we're fundamentally driven, right? Your typical private equity is you buy these businesses, you lever them up. But for us, we focus on organic growth first and then growth through acquisition. We don't use any leverage for our funds, for any of the businesses, actually. So all of the returns that we've kind of been able to provide to our investors has been with zero leverage. So I think that is kind of the aha moment is these are essential services and we're building these things fundamentally, right? We want to partner with great owner operators. They're so good at what they do. We just help them take it to the next level. So it's very simple. It's not easy, right? Simple in terms of what this playbook looks like. It's not easy to execute. But that being said, we've now created a track record where we've shown investors, advisors like yourself, that we are able to execute time and time again.
And consistency in good environments and bad are really a key of what we value in a good investment manager. Again, one of the reasons why we wanted to bring you in today. So let's kind of move to the next concept of, if I'm a listener, what can this investment do for me? The first question I want to ask, if I'm sitting here as a new investor learning about this, what's the main job this investment is trying to do for my portfolio?
First and foremost, it's diversification. We're specialists. We don't just look at every single deal that comes across our desk. So specialists tend to outperform generalists in terms of your private market stuff. So for us, that's kind of number one. A big piece of this is kind of that essential services side, right? But number two is consistency. We've always paid out our targeted distribution of 8%. So we really want to kind of provide that consistent cash flow to our investors. Your typical private equity is you're buying and holding for 7 to 10 years, then you're going to get a balloon payment at the end. So we structured this investment to tailor a little bit more to the average investor, where they're getting cash flow along the way and they're getting these private equity type return. So I think that's what makes us unique from a market perspective. There's no bigger killer of wealth than losing years, right? Like negative returns. When you kind of see that wealth deplete, then you've got to play catch up. So for us, again, in those downturns, we're going to provide that consistent cash flow to you. And then when we're seeing the markets do whatever it was, 20, 25% over the last few years, we're going to be able to grow our businesses with that. And you're going to see appreciation within the assets. So for us, it's all about preserving people's capital. That's really what we're trying to do here, and take away some of that public market volatility, right? You see it all the time, the ups and downs of the public side. And for us, the consistency return profile that we provide really helps kind of diversify your portfolio that way.
One of the things that private equity to the table is to bring in what we refer to as absolute return.
Mhm.
If the markets are doing good, we want this to be a certain rate of return. If the markets are doing bad, we want it to be doing the same rate of return. And I think that that's the beauty of smaller enterprises like what you guys are targeting here. You mentioned the differentiation between these smaller size companies and the bigger ones that the big private equity companies go for. The nice thing about being smaller is you can pivot faster.
Yes.
Generally, there's a lot more creativity that can be implemented than if you're a big company that has to go to a board. There's a long process. I like how smaller companies generally have an ability to pivot like that a little bit faster. Just a bit of a loaded question because I already know the answer. How many payments have you guys missed to investors?
We've missed zero. So we have always paid our investors on time, all those quarterly distributions. So again, consistency is really our business model. We want to make sure that our investors are getting what we've targeted.
And I know that past performance doesn't indicate what's going to happen in the future, but I do like that when management is able to remain committed to that and kind of show that they're consistent in that, it does form a large part of the decision making. Let's talk a little bit more about the specific investment itself. What is your target return and how do you frame that from a risk perspective? Because obviously it's not guaranteed. So talk to us about the positives and the potential negatives.
I talked about this a little bit before, just in terms of kind of providing that consistency for our investors. But our target returns are 8 to 12%. We're not trying to kind of recreate tech pub market security returns. That's really not what we're about. We're trying to preserve investor capital. That's really what we're trying to do. And how we do all of our underwriting is we base the cash flow from these businesses that we're buying on that 8% distribution. So we want to make sure that after all fees, et cetera, we're able to pay that at 8% distribution to our investors. And there is significant room for growth. And again, going back to what types of businesses we buy and that EBITDA level that we're buying at, that really allows us to create a ton of growth. And a couple of good examples I can give you, Eric. The last 3 dispositions that we've had, we've grown. So in 2024, we had a sale of IFSS. We grew that from, I've got the numbers here actually. We grew that from about $1.8 million in EBITDA to $5.3 million in EBITDA. Ended up selling that. 1.6 to 5.7 on the sale of Insight Engineering. And then for MacFire, we went from 4.8 to 6.8. So we want to make sure that there is the ability to actually grow, one, organically, and two, through acquisition. So those are kind of the big drivers for us, aside from just making sure these businesses are able to contribute enough cash flow to then give back to the investor.
I appreciate those examples. Taking a step beyond that, what's the total assets under management right now for Newlook Industrial and then Newlook as a whole, including all of the other?
Yeah. So including all the other entities. So for us, again, we've kind of been in disposition mode. We've sold a lot of our maturing assets in the last, call it year and a half here. So currently our assets under management is around that $125 million mark. We're looking at acquiring 2 more platform acquisitions with a couple more tuck-in acquisitions. So we should be getting closer to that $200 million mark kind of here in the next, call it 8 to 12 months. So we're always building, right? That's the nature of this evergreen strategy is we're going to be buying and selling assets in perpetuity. We've got assets in all different stages of their life cycle. And then Newlook as a whole is approaching that $500 million mark. So again, we're really focused on growth in 2026 and beyond. And we've got a great investor base to be able to execute on that.
Hey, Jim, you got a question?
I've
I
had
feel
my
like a
virtual
school
hand.
teacher.
Well, I've had my virtual hand up for a while. I think you're ignoring it.
Shoot, I see it. It was hiding behind something.
But this sounds like a very sophisticated type of investment, right? For someone who's kind of listening, they're thinking, this isn't for me. I don't really understand it. I probably don't have the money to invest into something like this. A lot of people assume that you can only invest if it's a non registered. So, who can potentially invest in this type of investment, the industrial investment? Do you have to be sophisticated? Do you have to have millions of dollars? And can it be held in your registered accounts?
I'll start on that, Jim. And at Newlook, we structured all of our products to be available for the average Canadian. We wanted to create institutional quality products that all retail investors can invest in. So for us, the minimum investment is $10,000. So the answer to your question of, do you need millions to be able to invest in this? The answer is no. At the end of the day, we want to make this accessible to effectively all Canadians. And Eric, maybe you can speak a little bit more to that, but it's available for accredited investors as well as eligible investors. And again, kind of going through your dealing representatives or your advisors is obviously the route to take in terms of whether this is right for you.
Yeah, when someone invests, like say someone has $20,000 and they want to invest in New Look, $10,000 as a minimum is going to be really hard for them to invest because all of a sudden you have half of your investable assets in one holding. So I like to see a client have over 100,000 of investable assets in total before we start allocating to private companies. There are some private investments that have minimums as low as 5, but really the rule of thumb is that most of them are around 10. Some are as high as 25 or 50. So first of all, you've got to make sure that whatever you allocate to New Look Industrial is a small enough portion that it's not putting your portfolio basket at risk in a major way. That being said, an eligible investor, the qualifications for eligible investors are either your personal income is around 75,000 or 125,000 with a spouse, or you have 400,000 of net assets or more. And accredited has its own set of qualifications, but really if you're above that eligible line, then this can really start to be something that you look at as a solution for your portfolio.
Right, and in addition to that, because I know some people have a misunderstanding where they think it has to be a new RSP contribution or a new TFSA contribution, but if they already have RSP assets somewhere or TFSAs and they want to transfer some of those assets so they can invest into one of the offerings, they can do that.
Yeah, that's a good point because I didn't even think to write that into the agenda today. But these are registered account eligible. So transferring a LIRA, transferring an RSP, transferring a TFSA, or even new contributions are eligible for all of this. So as we build your portfolio, it becomes very easy to look at all of your accounts and say, okay, well, let's allocate some of these to the private market and maybe your TFSA to this one. We do like to put registered funds into those because if you're earning an enhanced return, well, that's where you get the best use of those tax sheltered accounts. So something to keep in mind that's part of the conversation we have with every client we sit down with when we're talking about allocating some of this to their portfolio.
Okay. Is it return of capital? Is it a combination of return of capital, capital gains, dividends? Maybe you can talk a little bit about that for someone who's in non-reg.
The targeted distribution is 8% as return of capital. Now, that does kind of change, obviously, if we have dispositions of assets in certain years, then it can become obviously capital gains or dividends depending. But the idea, again, is to have that as return of capital until your cost base becomes effectively zero. And then after that, it becomes capital gains. So it's a way for deferred tax effect.
Yeah, so probably ideally, this is an investment to be held in a non-registered structure as opposed to registered. You can hold it in registered, obviously, right? But for someone like we have GIC lovers, right? Different, obviously, type of investment structure, but they love the 2% and don't realize that half of that's going to taxes. So we also want to talk about tax efficiency in addition to risk profile, but there's also tax efficiency because that definitely eats away at someone's wealth. Is the amount of tax that's going to CRA, which I've never met anyone say they love paying those taxes. So, all right,
Yeah.
awesome.
And a quick caveat too, we aren't tax advisors, so none of this is tax advice. Make sure to talk to your accountant and your advisor. But yeah, generally these tax situations are quite predictable, but yours is always going to be unique. And so one size seldom fits all. You have questions, give us a call. We can kind of help you navigate that. Let's get into the risks, Kyle. When someone is going to invest in this, what are the big risks and challenges that you guys face that really have to be managed so much that you've got them at the top of your priority list to keep an eye on?
Yeah, no, I think that's a great question. So for us, I think obviously you've kind of got your two risks, right? You got your systematic risks, your market risks, and then you've got your idiosyncratic. So for us, the market risks, I've outlined how we mitigate that, right? Being the essential services, the code mandated aspect of things. So no matter what's going on outside from an economic perspective, we do invest in assets that we believe are going to be able to perform in those times. Now, at the individual company levels, and when we're looking at buying new assets, execution is key, right? That's going to be one of our biggest risks that we have. So, as we continue to build this track record that we have developed, it helps take away a little bit of that risk that I've been talking about. So, for us, we want to make sure that we're buying the right companies, we're able to grow them properly, and then obviously from a sale perspective, want to make sure we're getting kind of top value for that. So I would say that's one of the biggest risks is execution risks. But based on our last three sales that we've had, you can kind of see a great track record that we've developed. So we are mitigating some of those risks, mitigate risks through geographic diversification. We've got US and Canadian companies as well. So Canadian dollars coming up to our fund and US dollars. So we've got like kind of a quasi currency hedge as well. Aside from execution risk, we want to make sure we have great people from the operating partner level all the way down, obviously to the men and women boots on the ground, right? The laborers. So that's obviously going to be a risk anytime you're hiring new employees, trying to retain employees. That's a risk. But again, we've been doing this now for call it 8, 9, 10 years, and we've kind of continued to create a framework that works well for us in retaining employees and finding great ones.
And Kyle, are you guys focused in Canada or is it North America?
North America, yes, we're about 65% US, 35% Canadian.
So is currency another risk that people need to be concerned about?
We try and have it kind of close to that 50-50 mark. So that 50% of the revenue is coming from Canada, 50% is coming from the US, and it creates kind of a currency hedge that way.
Right.
So I would say it poses minimal risk or less so than being all in one of those geographies. But if it's not 50-50, there will be some inherent risk there for sure.
Is government a risk at all in any of the regions that you're in? Because I mean, government can change what their rules and laws and requirements are. Is that a realistic risk that people have to worry about?
I don't know if I'd call it a realistic risk. Again, regulation seems to be something that's always increasing. We're not really getting rid of regulation, whether that's Canada or the US. So we're very comfortable kind of playing in that space. And then obviously we've got a full team on the industrial side that keeps up to date with what's going on from a regulatory perspective with the governments in Canada, provincially, as well as obviously federally. Same with the states down in the US. So we try and keep, stay on top of things. I'm not going to say it poses zero risk, but we have kind of taken all the steps to mitigate that risk, I would say.
It's possible, but not probable.
I would agree.
Right. Okay.
On that note, Kyle, you mentioned systemic risks, and one of the first risks I always tell clients before they invest in the private market is that one of the biggest risks in this is the potential risk of time and illiquidity as a result of that. Maybe comment on how you guys deal with illiquidity. There's liquidity, there's redeemability, and there's illiquidity. And redeemability is not to be conflated or confused with liquidity. Just because something's redeemable, that redemption window can close anytime. And so maybe tell us about how the redemption process works briefly and what you guys do to try to ensure that that's a pathway that's open And then also, what's the potential of it closing? One of the things that a lot of people don't understand about the private equity market is that you don't have a secondary market to go sell your shares on like you do with public companies. If the market's crashing, then a public security, of course, you're going to have a problem selling it for a higher value than what the market says. But it's a completely different challenge when you don't have anywhere to go and resell those shares. And essentially, a redemption program is your offer to rebuy those shares. So, what are the conditions around that redemption possibility for clients?
First and foremost, we're very transparent in how we're doing things, right? We want to frame this investment as a relatively illiquid investment. We're buying real businesses at the end of the day, and our goal is to have your money for 5 years. That's, why we have the redemption schedule that we do have. And in return for that, again, you're going to get that consistency. You're going to get those targeted returns that we're looking for. There's obviously that premium to be paid for illiquidity. And to be honest, I started framing illiquidity as more of a positive than a negative. It kind of saves people from themselves, right? I don't know about you guys, but I manage my own money in the stocks away from the private markets. I've got both. But in my stock portfolio, I see a lot of volatility. And for me, it takes everything that I have learned and to put my emotions aside when I see that stock drop 5, 10, 15% to not sell, right? So I think it's all about framing to start off, right? We want your money for 5 years. We're here to build businesses, and those are the investors that we want along for the ride. Taking a look at the OM and the actual redemption policies that we have, we understand that people's liquidity needs do change, right? Life happens, and sometimes you do need liquidity. So we have it as a percentage of the units of the fund. So if you need your money back, you let us know in any given quarter. At the end of that quarter, we're going to be able to pay that redemption. And if it's within a 5-year period, there's going to be a slight discount to what your net asset value is, again, accounting for that illiquidity. So for us, every quarter, we have liquidity at 0.5% of the units of the fund. So as the fund grows, the liquidity actually grows as well. We have never missed a redemption on a quarterly basis. We've always paid out our investors in time and in full. So again, I think it really starts with how you're framing things. And we're very transparent that we want your money for 5 years. If life changes, we do have that facility to be able to pay you your money back.
So, to kind of take that a step further, then, what's kind of a worst case scenario? What would make this timeline go far beyond what you kind of expect it could or should?
Like in terms of the 5-year redemption period.
Well, and just how long that an investor could be in this, because from what I understand, it's kind of a 5 to 7 year time frame is really the target. Say the economy goes completely in the tank and we can't find a buyer for these assets. What happens if we go longer? Uh, what could trigger going longer like that? And if that was to come along, what might be done?
I think for us, again, being on that essential service side of the businesses, we're buying. If we don't have buyers for these types of like the backbone of the economy, I think there's bigger issues than kind of what your investment is looking like. But after 5 years, there's no redemption penalty. So you're kind of scot free after 5 years. You're able to redeem if you would like. There would have to be some serious macro issues going on for us to not be able to kind of pay those or those redemptions out. Because again, aside from having cash flowing businesses as number one, we always hold extra cash on hand to be able to pay these redemptions in these dire cases. And we also have extra facilities if need be to take lines of credit, et cetera, to be able to pay those redemptions. So we have a lot of kind of checks and balances across the way. But again, number one is these are cash flowing businesses, so they're able to spit out distributions to our investors. So again, if we're not able to find a buyer, that's kind of okay with us because again, they are producing cash flow for us and we're able to kind of take that cash flow, use it as distributions and redemptions if we have to. So it's not like a pure growth play where you're just buying and holding and hoping that you get a massive multiple expansion through leverage. So I think we're very methodical of the businesses that we're buying so that we can mitigate the risk that you're talking about, Eric, as much as possible. And if it comes to a point where we're not able to do that, I think the broader market will have some fundamentally larger issues at hand.
I have heard, I don't know who's attributed with saying it. It primarily comes from the real estate industry, but they say you make your money when you buy it. And I believe that with any good investment that really that first decision is really what plays out how the rest of the experience is going to go for the most part. And if you buy right, then again, like you said, we're going to have to get 8% for 5 years longer than we thought. That's still not a horrible place to be in, provided the businesses can still produce like that.
Obviously, our other fund is dental, and I use kind of the same analogy there is if people stop going to the dentist, we have kind of greater issues on our hand. Like people are never going to stop going to the dentist in Canada, right? It's just not something that's going to happen. And these are all the same types of businesses on the industrial side that we're buying. These are businesses that are essential.
Maybe we can let Ryan in here because he's been sitting there patiently, looking pretty. He probably has like a bunch of questions lined up right now. So Ryan, do you have anything that you would like to say?
Well, it's less questions, but when I joined TVH, I'd been with some other institutions. As an advisor, I had no idea about what the opportunities were with private investments. So thank you, Jim, for opening my eyes, Yoda.
You're welcome.
And that if you go to your local bank, they're not going to be offering these things. So again, we've always said that this is about education and just making sure that people are aware, but what diversity of your portfolio truly means. And that's why we do this podcast, is why we introduce people like Kyle, is that you're not going to get it from your bank advisor. You're probably going to pay more tax. You're definitely going to pay more taxes in life if you just stick with them. And that there are a lot of advisors, as I was years ago, that had no idea about this option that was out there for people to invest in simply Kyle, you had said it, a very emotionally driven markets, right? This is not an emotionally driven market that you're looking at. And I invested in myself, so I'm always excited to share with clients about what I'm invested in. I can't speak much to it because I need to bring in Eric, but that we're very careful as to what's the strategy that is best for that person, their comfort level, the risk that they're willing to take. And, Eric, you and I are working with a number of clients right now. It's like some want to jump all in where we're like, hold on there. Right?
Easy now. Yeah.
Easy there, right? It's not it, but we want to make sure that you're taking the right steps and that your portfolio isn't maxed out in one area or the other, that you're finding a great balance, and that no matter what the markets do, that there's stability within your portfolio as a whole. So I think that's the only thing I wanted to add. So
Well, Ryan and Colin, I think you both made some pretty good points when it comes to the emotional side of things. Because as I think back to the periods of time where we've had some corrections, usually a client's calling saying, I want to talk to the portfolio manager because what are they doing with my investments? And then I'll ask, well, do you want to talk to Eric as well on the private side? So, no, we're not worried about those. We're more concerned about, what's happening in the stock market. Right. And then I think, Eric, you had a story about 2008 or 2009.
I had a client call me one day and say, "Hey, you're making it really difficult for me at work." And I was like, I'm sorry, how so?" And he was like, "Well, everyone's complaining about their portfolios dropping, and all of my private stuff in particular, they asked me how I was doing, and it's paying 8%." It just was one of those eye-opening moments. People really don't understand what this brings in, and sure, this doesn't mean you put it all into the private side, but true diversity is having assets to do different things at different times.
Mhm.
And that's one of the things that when I mentioned absolute returns at the beginning of our conversation here, to have that as a portion of your investments. And sometimes things are doing good, sometimes things are doing bad. But overall, you want to see your entire portfolio really being as consistent as possible. It's hard to find that consistency or that potential for consistency like we see in a lot of the private side in the public side, because the public side, Rogers can be having its best year ever and the price could drop. Bell, the same thing. There's not always complete logic into why that it's moving the direction it is. They say orange man tweets and everything changes. Your markets can go up, your markets can go down. When you have something that acts differently than that public market, the benefit is significant in my mind.
Yeah, and I think what I really want to kind of highlight here in the benefits of working with TVH Group. I mean, we have the four pillars that we've talked about on the TVH financial, the financial services, and the mortgages, and the accounting, and the legal. But also the fact that we are multi-licensed, and that's how we're structured. Because to your point, Ryan, if someone goes to the bank and they're looking to structure a portfolio, private assets is never going to be really a recommendation. It's going to be either some stock and bond portfolio. We've even seen Eric with one of our referral partners where they've done a little bit of their own research, where they've looked at their high net worth clients at the banks. They're basically invested in the mutual funds just with a reduced management fee, but they really don't have the exposure to the private side, right? Or if you're working with a mutual fund advisor at one of the independent firms, they're not recommending private assets. They're going to be recommending just the mutual funds. And I'll even talk about the insurance industry. If you're dealing with an insurance advisor, they're going to be stressing or pushing a segregated fund contract, which is something that we do a lot of as well. But we don't only recommend those because, again, we are multi licensed, multi-disciplined. So I really wanted to stress that and highlight that with people that are watching and listening. The benefit of working with TVH is not only the four pillars, but the fact that we are multi-licensed. So we don't have those biases. So if it makes sense to place some money in on the private side and as the industrial fund or dental fund or whatever other fund we have, there isn't a bias. It's strictly based on what are your long-term goals, what are your needs, what are the suitable style of investments that we should be holding for you and recommending.
It's good that you brought that up, Jim. It's important to note that when I sell these kinds of investments to clients, that I'm a dealing representative with Raintree,
Mhm.
who is our investment dealership. I'm an advisor at TVH, part of the TVH Raider ecosystem. But when you're talking to me about Kyle's Newlook Dental or Newlook Industrial, I'm talking to you as a dealing representative that's registered through Raintree Financial. And so that's an important distinction to note, but it doesn't change the fact that when we bring TVH to the table, there's a whole process in how that fits in. I don't want to just be a salesperson. I want to be a planner that really looks at a holistic situation and says, this is the overall mix that will benefit you most. And private investments through Raintree with companies like Newlook are one of the kind of tools in my toolbox in that sense. So I think we're earlier than we normally are, and normally you can't stop us from talking.
We're at 51
But
minutes, so we're there.
to kind of wrap it up, first of all, I want to thank Kyle. Thank you again for coming on this show. It's always great to have companies doing really unique things really well. And that's really one of the biggest challenges to find, and New Look has done an exceptional job at both of those. So I want to emphasize again that this is education, not advice. Past performance does not indicate future results. And the offering memorandum and the offering memorandum materials, that's what you need to make sure you look at before you move ahead. And speak with a qualified advisor, either your own or give us a call. You can reach out to me at any time. My email address is eric@tvhgroup.ca. My phone number is 780-306-7359. Whether this makes sense in the broader plan or in an individual basis, give us a call and see how it fits in. And if you have other challenges, TVH really does have a broad base of expertise to help you find the best options that are there for you. So if someone's intrigued, Jim, and wants to keep on following us, where do they go to do that?
Well, we have our social media platforms, obviously YouTube, LinkedIn, Facebook, X or Twitter, TikTok, Instagram.
I
Obviously,
can never remember them all.
yeah, we have them all. We're not on Twitch yet. I keep looking at Twitch thinking maybe we should be on Twitch, but anyways, that's for another day. And obviously you can go to our websites. We have tvhgroup.ca, which is our main landing page, and that's where you'll be able to see the four pillars that I've referred to, or you can go directly to tvhfinancial.ca as well and find us there. And I think, Ryan, you're going to have to develop something here because if we have Kyle back for a third time, I think that'll be a record. And kind of like Saturday Night Live, don't they have like a guest host thing where you've guest hosted so many times, you're part of this club or group? So I think we're going to have to create our own little group now or club.
Monday afternoon live. Yeah, that
Yeah,
doesn't
something
sound
like
as
that.
exciting as Saturday night, but I'll take it. So I guess in wrapping up, thanks again, Kyle. Appreciate you taking the time to come on the show. And thanks, Jim and Ryan, for contributions. You guys know where to follow us and reach out if you have any questions. Looking forward to helping those out who need it.
Yeah, and we will be sending this out as well, the recording itself. So it will go out on our podcast, YouTube, blog post, newsletter. So we do encourage you to sign up for our newsletter as well, so you can get the updates on when these episodes do go out. We are looking at having one more on the 22nd, so stay tuned for that one. And then we're probably going to take a summer break, although we might dip in once in a while, depending on what's happening out in the world. But yeah, this will probably be our second last one until September. So thanks again, everyone, for watching and listening. Take care.
Awesome. Thanks, guys.